Welcome to the Investors Trading Academy event of the week. Each week our staff of analysts and educators tries to provide you with a better understanding of a major market event scheduled soon and that have an effect on the global markets. Greece's Prime Minister on Friday called for a surprise referendum for July the 5th on the financially troubled country's fraught bailout talks with international creditors, and government officials are calling on the nation to reject the proposed deal. Alexis Tsipras announced the referendum in a televised address to the Greek people early Saturday, following an emergency meeting of his cabinet. The Greek government has been asked to accept a proposal that places new unbearable burdens on the Greek people, Tsipras said. Right now, we bear an historic responsibility concerning the future of our country, and this responsibility urges us to answer ultimatum based on the sovereign will of the Greek people. The move radically raises the stakes in Greece's confrontation with bailout creditors, whom Tsipras accused of demanding new pension cuts, sales tax hikes, and labour market reforms. Tsipras said an emergency session of Parliament later Saturday would be called to ratify the decision. The question will be acceptance or rejection of the bailout creditors' proposal for a new deal, Tsipras said. His radical left-led government had already said it rejected the latest proposal from representatives of the European Commission, European Central Bank, and International Monetary Fund. Greece will ask for an extension of its loan repayments until after the referendum on July 5th. The move brings to an abrupt end a series of discussions aimed at finding a way for the creditors to release the remaining €7.2 billion of Greece's huge bailout, in return for budget savings and economic reforms. Without an agreement on its international bailout, Greece faces the threat of running out of cash, defaulting on its loans, and possibly leaving the euro currency. Without an $8.1 billion bailout loan instalment, which would only be available if there is a deal, the country will be unable to make a $1.8 billion payment to the International Monetary Fund, and even bigger payments later in July. The government could soon run out of cash, face huge difficulties in paying pensions and civil servant salaries, and that could force it to leave the Eurozone and adopt a weak national currency.